Welcome to IN60, where my guest is Christian Munafo, Chief Investment Officer and Portfolio Manager at Liberty Street Advisors. Welcome, Christian.
Hi, James. How are you doing today?
It's a pleasure to have you. I'm good. Christian, I'm going to ask you a series of short, sharp questions, where after short, sharp answers, you'll have 60 seconds. You can pass, and your time starts now. Christian, where does late-stage venture capital sit in the hierarchy of equity?
Yeah, think about late-stage venture as sitting in the middle of early-stage venture, thinking about the inception of ideas and companies on one extreme, and the other extreme, much larger, maybe buyout stage, publicly traded companies. Late-stage venture is kind of in between the two as they mature to that next phase.
If you're not swinging for the fence in this particular area of private equity, what's the ballpark range of returns that investors in this niche usually expect?
Yeah, we think investors should usually expect somewhere in the 15 to 20% return range net of fees and expenses.
What's the most appropriate time frame to give a late-stage venture capital investment?
Typically 2 to 4 years from the date of the investment.
Beatles or Rolling Stones, the better band?
Got to go with the Stones.
Is late-stage venture capital suited to the true retail investor?
We think that there's an interesting allocation available for all investors to have exposure to private high growth late-stage innovation.
For an exit, do you have a preference between an IPO and a trade sale?
Obviously, whichever pays the most, but the IPO often comes with the potential volatility of how that stock will trade in advance of when we get out. So all things being equal, we would prefer an all-cash M&A deal at the same price.
Do you always get out in an IPO, or do you stay in some companies post-float if you really like them?
Yeah, typically you have to hold on for what's called a lockup period of 6 months after a company goes public. And at that point in time, we typically will get out in an orderly manner. We're not paid to take public market risk. And so we typically will get out unless there's reason to hold on for longer.
Christian, what's the biggest worry for you right now as an investor?
So I think it slices both ways. We obviously have geopolitical risk. We have, inflationary risk here in the States, increasing rates environment. So I think one, in a protracted environment that can create a lot of pain. It also, on the flip side, creates a lot of opportunity. And so as an active investor, we can take advantage of dislocations like this to build very interesting entry points for our clients and portfolios. But we never like to see long-term protracted periods of pain like this.
Does pineapple belong on a pizza?
As someone of Italian descent, I would have to say no, unless you're in the Hawaiian Islands.
Does being in private equity venture capital shield you from the concerns of stock market investors?
To an extent, it does. You don't have the same exposure to the idiosyncratic behavioral volatility that you see in the public market that doesn't really hit the private market. It doesn't mean that it's immune to real legitimate macro changes that are happening in the overall landscape, but it does provide some air cover, if you will, to idiosyncratic daily volatility.
Is inflation a particular concern in your investment niche?
It's a great question. It really depends. I think in the near term, we don't think that the reason to move away for investing in late stage private innovation companies is inflation. We think what inflation can do is potentially create an environment where it's harder for companies to get liquid, to pursue exits, and maybe it pulls back valuations. So maybe it just kind of pushes off some of the valuation and exit opportunities. But long term, we don't think that an inflationary environment is going to be a death nail for this industry.
This has been IN60 with Christian Munafo of Liberty Street Advisors. Thanks for your time, Christian.
Always a pleasure. Thank you, James.